So the time now, 11:30 here in London. Going to do a quick run through then before we get the key economic data for today, 1:30 London time. We're looking out for that 2 hours time. So kind of going to go through this in the order of the context of the week, how I basically go about formulating my ideas about how I think the number could come out. We'll have a quick look at what that means for the Fed on a broader basis, and then also more interestingly how to then action and tackle the event over the actual release itself and thereafter. So first of all, let's just take a look at non-farms as a data set and where the land lies, so to speak, more recently. We'll look at the chart shortly of last month, but you can see here it was a really surprising number to the downside. 160 was the expectation, 90 was the low end of the range, and we had a print of 38,000. That's coming after we've been on a continuation, a downward trend for the last 4 months now. You can see we were tracking up at around 233 as of February, 186, 123, and all the way down to 38,000, which if I put this on a slightly longer dated, you can see certainly a multi-year low here. I have to go out more so to around the 10-year graph in order to really fully show you the situation there with the headline growth figure. Now, a slight caveat with that number last month was you had a large proportion of Verizon workers that were on strike, and certainly that did affect the number, and that is one thing that all analysts and you yourselves will need to contemplate. We would be expecting roughly 35,000 jobs at least to bounce back on that reading. So certainly not expecting anything as low as 38,000. If anything like that again, would be a huge surprise to the market. Now looking at this chart, so you can see here the monthly change in non-farm payrolls. The 3-month average is highlighted in the blue, the actual in red. You can see certainly we've been on the 3-month average. If you were looking late 2015, remember when the Fed hiked rates? Seems like a distant memory now. Certainly the next rate hike off the cards for the near term. But look where we were tracking at the time when the Fed did hike rates at the end of last year. Now this number was significantly higher on an average basis than where we are at the moment. Now that's been a pretty quick move to the downside. You know, the combination of the uncertainty and volatility that caught the markets off guard at the beginning of the year in 2016 certainly caused a lot of nerves in the market. And then more recently, obviously, you've had more external headwinds from a US perspective emanating out of the UK and our vote to leave the EU. And then the potential contagion effects that might lead to. And we've seen that, obviously, on a UK side. Not only is that now affecting business confidence, but also consumer confidence down at its lowest since 1994. You know, from a practical point of view, from a corporate side of things, you know, if you're a company planning on hiring further staff, you know, would you be planning expansion to your business and your workforce at this particular point in time? So again, these are all important things to put it in context. Having said that though, I did share with you in the briefing this morning, worth another look, is for anyone who missed it, this is a kind of spider web diagram that tends to get floated around fairly often. But this is certainly more supportive of the argument that actually the employment situation, despite the weak headline, the underlying components on these various different factors is actually quite strong. And certainly much stronger than where we were back in the financial crisis. If you look at the red center circle of December 2009, all these metrics were far, far lower than where we are at the moment. Pre-subprime crisis, or even better than that by most metrics. It's only really some of these other areas like job finding, part-time for economic reason, marginally attached. They're the ones that are still lagging slightly, that some people are looking for further pickup on. But overall, the number of job openings, hiring taking place, temporary help that's wanted, these are all things which now are in a better shape going forward. Now that's why, from an economic and Fed monetary policy point of view, how important is today's number? For me, I don't really think it's that important when looking at a broader macro perspective. At this point in time, interest rate hike from the Fed has been pushed a long way down the line. If we were to reverse the clock only around 6 weeks ago or so, we were talking about potential rate hike June and July. That now certainly will not occur, and the next rate hike from the Fed might not even happen until around 2 years' time from now, according to market pricing. So today's number, whether it's exceedingly strong or exceedingly weak, how much of a difference is it really going to make? I mean, certainly if we get a number that's more akin to sub 38,000, that could possibly be a policy game changer. You've had Fed minutes out most recently. They've obviously highlighted the fact that they've digested that very poor reading last month, and they've kind of given the message that we can't read too much into one report itself. We need to keep monitoring incoming data. So that does, in a sense, heighten the importance of this figure. But in effect, what I'm saying is that unless we get a complete and utter disaster, the market has already delayed a rate hike, so to speak, from that side of things. So let's just focus a bit more on the here and now. Let's move away from Fed policy and let's look about how do you gauge what the market is expecting from today's number. Well, this is when you look at all of the employment data points that come out in the run-up to non-farm payrolls. One of the most historically watched ones then is the private payroll report that gets done by ADP. Now, that came out yesterday, and if you remember market prices yesterday, we actually got a bit of a lift on the back of it. That's because it came out at 172,000, which was actually slightly stronger than expected. There was a very minor revision to the previous. I think, if I remember correctly, it was around 5k, but it exceeded the expectation by a larger margin than that. And if anything, remember the downward trend we were on with non-farm payrolls, you've almost got the reverse taking place with ADP. We were up at around consistent 200 type level at the beginning of the year. We dipped in April, but since April, 149, 168 and 172,000. It's been on an incremental climb ever since. Now, keep in mind that there was around 135 odd thousand divergence or so between ADP at the time and non-farm payroll. So the correlation certainly has broken down if last month's to be taken on its own. But a good number nonetheless. So that's the ADP side of things. The other important metrics to look at here are the ISM readings that we've had. So what I'm sharing with you now is the ISM Purchasing Managers Index. So this is the manufacturing number. And you can see here, again, solid improvement, a pretty strong number. And most importantly, it was the highest number since February of 2015. New orders growth accelerated. And the key part here, employment expanded for the first time since November. Again, not only is this a strong report, but particular focus on the employment constituents of these reports that give you an inside indication of the underlying health of employment for that particular set of data. So that was the manufacturing side. If we flip over to the non-manufacturing side of things, again, a good bounce back on the headline reading. And if we were to move over to the actual components, it was the highest reading here on the headline since November last year, boosted by new orders, new business, and recovery again in employment. And if you think about initial jobless claims as well, those weekly numbers we see on a Thursday afternoon, they remain supportive as the 4-week average is 265,000. So that's actually the lowest since April. So you've got lowest weekly jobless claims in quite a long time. You've got improvement in both ISM manufacturing, non-manufacturing employment constituents, and you've got a forecast beating ADP number. Now you can see where I'm going with this. These are all good numbers, and as a market, all it can do is start to then price in expectations. Now, any of you who've gone through my news lecture, you remember me talking about the difference between consensus estimates and whisper numbers. Now, I've not heard a explicit whisper number as yet, but let's take a look at how I would probably derive a number out of what we're looking at from what's expected. So this is the change in non-farm payrolls on your calendars. Expected 180. And we've got a range of 130 at the low to 239,000 is the top end of the range. Now, all the components we've just discussed have all erred on the side of being more positive than negative. So, if anything, I would say the market is now positioned psychologically for a figure of 180 or better. That then means from a market impact point of view, the bigger reaction I feel will be if we get a poor number. If we get a number sub 100, that's going to cause, for me, a better trading situation or scenario because the price movement will be a lot more sharper with stronger conviction. That being said, if all the components of the report all line up in the right direction. Now, I've had a question to me this morning, what order of importance and how do I sort of look at this payrolls report? As you can see, there's probably 8 or 9 different things you need to look at. It's not just the headline reading. Now, any of you who haven't seen non-farms before, one thing I want you to do ahead of the figure is I want you to pick an asset, whether Eurodollar, Treasuries or the S&P, and I want you to watch it a few seconds before the number comes out. Now, this isn't a hedge fund or an algo trading a number 1 second before it comes out. This is the market at its most illiquid, so to speak. Now, from an institutional point of view, a professional prop trader, no one in their right mind would carry a position on an intraday for sure going over into the non-farm payrolls report. Just way too much volatility and uncertainty on how the price action might unfold. That's why you get a huge amount of chop around 1 to 2 seconds just before the number comes out. The best thing is don't panic. Let the number come out. Let the initial noise subside. So in what order do I place importance on these? The first number is the headline reading. That will always be the first kind of snap reaction you normally get with non-farm payrolls. Now remember, the size of the price impact is going to be dependent on how far out of line it moves away from the median consensus, 180. Any number below 130, any number above 240 is going to cause a bigger reaction. So when I'm listening, that's the first kind of number I look at or wait to hear. From there, the next important point in which the Fed are looking at from a policy point of view is although job creation has been slowing on a 3-month average, it's still holding up fairly nicely. Then it's about the pace and consistency of growth in average hourly earnings. So that's then where my attention turns on the second part of the report. Here, expected at 0.2% month-to-month, 2.7 year-on-year, both of which would be, the month-to-month would be the same as the prior month, but a slight uptick on the year-on-year. Third, I then need to look at the revision to the previous being 38,000. Does that get revised substantially, whether up or down? Then I turn my attention to the 2-month net revision. From thereafter, the unemployment rate, and probably lesser significance for me, private payrolls, manufacturing payrolls. So in order again, I'll look at the headline 1, average hourly earnings 2, the revision 3, 2-month net revision 4, unemployment rate 5. Now in order to trade this in its most cleanest scenario, let's say a bad report. A bad report would comprise of a number, let's say 100,000 below the low end of the range. I would need to see average hourly earnings at either flat or 2.4%, so much weaker than expected. An unemployment rate, if it stayed the same or a touch higher, and if the revisions were downward on both the previous and the 2-month net, then I'm looking for a rerun of what we saw last month. What I've done here on my charts, let me show you, is I've marked up a couple of assets on a minute candle and how they reacted to last month's report. Now, as I said at the beginning, last month's report was very interesting because although it was abysmal from a data point of view and certainly from a Fed point of view, and an underlying job creation, from a trading point of view, actually, it was a lot more clearer. What I'm looking at here is gold. This is gold on the minute chart on the release of last month's non-farm payrolls. Now, arguably, this was one of the clearest moves that we saw across the assets that we had. Now, when I hear the numbers, obviously the market reacts to the headline, but what I need to hear as well is, secondly, those average hourly earnings numbers are really important. If we get a weak headline but strong average hourly earnings, this movement, this consistent movement to the upside over 1 minute, 2 minute, 3 minute, 4 minute, all the way up and continued, would not occur. That's because not all the pieces of the puzzle are lining up to formulate the same picture, i.e. negative. So again, this is when I need all the data to go in my favor, i.e. all good, all bad, to get such an extreme move. In this case, if you actually look, the entry points are not the initial snap reaction. The market's going to move way too fast for that. But if everything else lines up and is particularly bad and well below bottom end of ranges in the other components, that's when you're looking to enter after that first pause. You know, if you're looking after that brief hiatus in price action up to the next 5 minutes, you still moved from around 32, 33 bucks up to 1,246. So there's still a decent trade and size there to carry in a short time frame. Looking at euro, I've got this on a slightly longer dated because, as you can imagine, weak payrolls, the dollar got hammered. Now, the reason I'm pointing this out is because what I want you to do ahead of these big events is build scenarios. You can see here the pop that euro dollar took on that one candle there. That was non-farm payrolls. If you look at this candle here, this was the EU referendum. Actually, the non-farm payrolls reading was a pretty sizable move. When you think about the referendum, the vote to leave was a historical event for the pound and for FX markets. That non-farm payrolls reading wasn't far off. You know, it was knocking on probably 60% of the same similar size move. Looking elsewhere, let's take a look at the S&P. So again, just highlighting here the release of non-farms. These are 15-minute candles. You can see though how it really set the tone ahead of Wall Street. So Wall Street opens at 2:30. That's there, that candle. That was when the data hit last month. An immediate downside pressure in equities. It went even lower. But the interesting thing here is, by the time we had actually got to the end of the session, we had reversed pretty much all of the move. Remember, the same could happen today if the number was an absolute catastrophe again. You know, may it force the Fed into adopting measures that we've heard the likes of the Bank of England, the ECB, and possibly the PBOC all contemplating further easing. Does it go from a conversation of rate hikes to more easing? In that scenario, that would be an equity positive as well as a treasury positive. Finally, the other asset, of course, to trade in that scenario is US treasuries. If you look at treasuries and you think back to that gold chart I just showed you, pretty much identical in the sort of price movement I'm talking about. You know, you can see here how that underlying trend, you saw that S&P chart I just showed you, equities recovered post the abysmal number by the end of the session. But treasuries remained bid. Now that's important, because then you start translating what we've seen into federal policy, and if lower rates for longer, potentially more easing, then that then becomes, after the initial reaction, actually a positive for equities as well as treasuries. A quick look at the S&P then. This is slightly longer dated, and I'm looking here, this is the weekly performance of the S&P. And we've had a kind of defined range of 20.65 3/4 at the low up to 21.04 3/4. Now, on the extremity of the report, on its most volatile reactions, this is when I'll be looking for upside. Certainly, we're very close A 9-tick move to the upside on a solid report, I don't think can be discounted. A breakthrough there obviously would take out the 2100 handle psychologically. Then from a longer term perspective, looking on my daily chart, that 2119.5 level is then the one I'll be looking at as initial near-term resistance on a solid number. But it's going to have to be a pretty punchy number to get it all the way up to that level. I think it's unlikely, because the market has already factored in to a certain degree the fact that we could have a good number today on those good data points we saw earlier this week. In fact, putting on the 15-minute, as I've been talking, the S&P's just been moving up to around its best levels. This to me shows signs of confidence ahead of the number that people think it's going to be a good report. That means for me, really, I only want to trade it if it's a terrible report, because that's going to cause the biggest reaction. Okay, that's your preview then for non-farms. As ever, good luck. My best advice is, unless you get a smaller probability, i.e. a repeat of last month's report in terms of overtly negative, I would say sit on your hands, let the noise pass. You always get a huge amount of volatility. If there is a trend thereafter, I'll be guiding you through. I'll point out anything I see in here. But the trade is better to wait a few minutes. Let the price action, the whipsaw price action fade out, and then the trend to materialize in the prevailing trend and theme thereafter for the rest of the session. Okay, good luck. And enjoy the rest of the session.